Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through Dropbox stock and doing some fundamental analysis. So Dropbox is a stock I've owned in the past. As you can see here, I bought it, let's see, back when it was, so in August of 2020, I bought some at $20 a share, some more at 19, some more at 22. And then I started selling in June of 2021 when it hit 29. I sold some at 31, I sold some at 30, and then I ended up selling another 90 shares at $30 a share. So I made a nice little profit off of that year. But if we go back, we can see that Dropbox today is now $22 a share. So it really, over the past 4 years, it actually had a very bad run here. It has not been too good. But what Dropbox does is, if we go to my page here, you can see, so Dropbox is an $8.5 billion company. They are primarily a cloud software company that helps people pretty much work together by storing and sharing and editing files, okay? They also acquired HelloSign, and HelloSign is a company that is similar to DocuSign. They aren't as big as DocuSign, but they do pretty much the same thing of allowing people to do the e-signatures. And so that's also another growth vector that Dropbox has going for them. The next thing is that Dropbox has over 16 million paying users and over 700 million total users. Most people are very familiar with Dropbox. They know how it works. I think a lot of people that do use Dropbox, they stick with it. And there's also, you can use Google Drive or some Microsoft products that do the same thing, but a lot of people like Dropbox. They think it's easy to use, and I think it's a pretty sticky business model. So if we get to my checklist here, we can see that the first one is the stock down? And yes, absolutely, it's down not only from where it was back in 2018, but even of September of 2021, it was $32 a share. Today, it's only 22. So it's down over 30%. Next thing is revenue and net income. We can see revenue, I gave a yes because they did $2.1 billion of revenue in 2021. And if we look right here, we can see that over the past couple of years, they have consistently grown revenue, and they've gone from 600 million 7 years ago to now 2.1 billion last year. So they're doing good with that. For net income, I also gave it a yes because it was negative for a long time. And last year they had their first profitable year of $335 million, which is very nice. So if we keep going, we can see number 4, do they have a healthy price to sales? I put yes. A 3.7 with 8% growth expected in 2022 is pretty much normal. I would call this a fair valuation. And so it's not, I wouldn't say it's cheap, but I would say it's absolutely fair. Then same thing with price to earnings, 14 price to earnings with 7% growth is to be expected. That's where it should be trading. And then number 6, are they innovative or do they have a moat? I put yes because of the number of users they have, right? 700 million users is a lot of people. So that's one thing they have going. Number 2 is the name and the brand they have. Dropbox is very, very popular. Then we have the ease of use. How I said the users really find it easy to use. And that's one of the things that they pointed out that they wanted to differentiate themselves from, was having their service easier to use for people, right? Then the last thing is that they kind of replace having to use a USB drive because you can just store your files through the cloud, right? Then we have growing industry. Yes, there is a 26% compounded annual growth rate for cloud storage, as well as 33% growth rate for e-signing of documents. So the two industries they're competing in are both fast growing segments. Then return on invested capital of 9%. This number is not bad, but not great. Somewhere in the middle. That's about average. So it's good enough. Healthy margins, gross margin of 81% is very high. Operating margin of 30% is good. The reason I put that on there was because a year prior, it was only 21. And then the year before that, it was only 12%. So they've made a lot of improvement there. And the final profit margin of about 15% is strong. That's a strong number. So that's going to get a yes. Healthy cash flow, yes. If you want to see exactly what it looks like, we can see here that one of the most important is the free cash flow. That's like the bottom line of the cash flow statement, and it's looking good. Everything looks pretty good here. We have a little over 300 million of free cash flow in 2018. This past year they did 700 million, and then they said on their investor deck that I believe in 2 years from now, in 2024, they aim to do $1 billion of free cash flow, right? So operating cash flow is going up. That's good. They are investing very heavily into the business. I believe maybe even too much. And then financing is good, healthy, where it should be. And then end cash position is it's okay. It's not fantastic. It's pretty much stayed at around this 500 mark for a while now. So not bad, but not great. But overall, free cash flow looks good. So we're going to give that a yes. Diverse revenue streams. Yes, I put not only because of the number of customers they have. So real quick, I want to show you this. This shows you their different subscription plans. You can see you have, as cheap as, first of all, you can use their basic service for free, right? And then depending on how many, if you're just a regular person using this, or you do this for your job, or you want to do this as a business, it goes all the way up to, so for the advanced one, it's $240 per user per year, or some of their contracts are probably even bigger if they're for their huge corporations. But that's the good thing about this business. It's not just for the average person. It's not just for businesses. They have everything in between. And then the other thing is HelloSign, right? They have all these different plans for HelloSign, and that's another way that they can make money and brings in more users, right? So those are the two things. I think since they have a lot of customers, and since now that they have HelloSign and they have cloud storage, I believe that's good to have that's enough to have a diversified revenue stream, right? Then we get to the balance sheet. This is really the only problem with this stock is the equity is negative. So these all had to get a no. And not only is it negative, but it was positive. And it's only been getting worse the past year or two. So that's the only negative thing with the stock that I don't like. And see, because back when I owned it, it wasn't that bad. It wasn't negative like that. So we've seen in 2019, they had 800 million in equity. Then it went to 300 million in equity. And now they're at negative 290 million. That's not good. That's not good at all. So they really need to, make a point to explain why that's happening and what they're doing and when it's going to get better. So that's probably the biggest problem or the biggest risk to this stock right now. Then we have, do they have a strong share buyback? Yes, they do. Negative 7% share change. They are definitely buying back shares, and that's helping out the stock. Now, are insiders interested? No, I would not say so, because if you look here, you can see over the past year, there's been way more selling than buying, right? And they even when the stock went down, they kept selling, and there's been a couple buys, but not even close to the amount of sells that there's been. Lastly, is it founder led, and how is the management? I put yes, just because the CEO is a co-founder and they've done everything right with the business besides the balance sheet. That's the only thing. So part of me wants to give that metric a no because of just how bad the balance sheet is. But I don't know. See here, my other problem with this is I'm going to bring this up right here at the bottom when I do my stock, my estimates. See, the other thing I didn't bring up was they have 16 million paying users, 700 million total users, and then they also are integrated with Google, Adobe, Zoom, Microsoft, and Salesforce, right? But here's the problem. So remember how I said the industry for cloud storage is growing at 26%. This is for the next, I believe, 4 years or 6 years down the road, right? 26% growth rate for cloud, 33% for e-signing of documents. Why are they only growing revenue? Why is revenue growing so slowly, right? They're only growing revenue at 7 or 8%. And that doesn't make any sense. Then I looked up, maybe that's tied in with the fact that, so I honestly want to change this to no, because this means that management is not doing a good job. Because they're in super fast growing industries. They should be growing revenue like at least 15 or 20%. Okay. Their margins are good. They've done a good job improving margins. Their return on invested capital is average. And they have a really bad balance sheet, but they have been buying back shares. So that's one good thing. But the balance sheet is really bad. That's an issue there. That does not look good at all. You cannot go from having, $800 million of equity to negative 300 over the course of a couple of years. That is not good. So I'm going to give that one a no. But if we go down here, the other thing I don't understand was it says that Dropbox has a 22% market share for cloud storage. That's what I don't understand, because if that was the case, for last year, the global market size for cloud storage was $76 billion, which would mean that they would have a lot more than $2.1 billion of revenue for last year. They should be doing more than that. And that's why I think the stock is trading so cheap. I think the stock is trading so cheap because, first of all, the balance sheet is bad. The balance sheet is doing really bad. But second of all, they should be growing faster. They should be growing faster, and they should be making more money than what they are. And that's probably why the stock is trading so cheap, because even though it's a good brand in a good industry, they're not doing a great job growing that company. And in 2026, the estimates are $154 billion for cloud storage. And that means that if they keep up at this pace, that means that they'll be doing $4.2 billion in revenue in 2026. Then if we look at the average price to sales for the last year or two, we can see it's been about a 5, right? Which would put the market cap at $21 billion or a $57 share price. This is a 2.5x ROI over the next 4 years. So that's pretty good. That looks really good there. And that's only if they can, that's if they keep up what they're doing, which they haven't been doing much. That's only with them growing at, I guess that would be if they doubled their revenue. So they would have to grow much faster than 8%. That's if they keep up with this market, right? So that's the only thing. It actually would probably be a lot lower. If they only are growing 7 or 8%, then the stock's only going to be like $35 in 4 years. But if they can speed that up and get to a 20% growth rate, then the stock will trade at a higher valuation. And yeah, so as of right now, I'm going to probably give this a no. I could see it coming back up to $30 a share, but it really depends on management and the balance sheet and how fast they're growing. And if those things improve, then I would be interested in buying, right? But other than that, so right now, this is going to be considered a no. But thank you for watching. I'll see you in the next video, and comment down below if you guys have any stocks you want me to analyze.